For most of the 20th century, higher education was widely understood as a public good. It wasn't just about personal advancement, it was about building a stronger society, training engineers, doctors, teachers, researchers, and informed citizens. Governments invested heavily in universities because the return wasn't just individual income, it was national prosperity. But somewhere along the way, that philosophy changed. Today, higher education, particularly in the United States,
millions of American students head to university with high hopes that a degree will be the ticket to a brighter future and better salaries. But more and more experts are saying that college is not for everyone and that many high-paying jobs, which don't require a college degree, are going unfilled.
Functions less like a public institution and more like a financial product. Students don't simply attend college, they finance it. They leverage their future income against present tuition costs. They sign these contracts that can follow them for decades. Education has become debt-backed. How did this happen? Well, the transformation obviously didn't just occur overnight. After World War II, programs like the GI Bill dramatically expanded access to college. Public universities were generously funded. Tuition was low enough that students could often pay with part-time work. In some states, public higher education was nearly free. The logic was pretty simple. If society benefits from an educated population, society should help pay for it. And for several decades, that model held. But beginning in the 1970s, political priorities shifted. Public funding for universities began to decline relative to enrollment growth. States reduced appropriations. Institutions were told to become more self-sufficient. The shortfall had to be made up somewhere. It was made up through tuition increases. At the same time, though, the federal government expanded access to student loans. Credit became the mechanism that allowed tuition to rise without immediately pricing students out. Instead of funding institutions directly, the system increasingly funded students, who then paid institutions. That distinction matters. When governments subsidize universities directly, they can exert pressure to control costs. When funding flows through individual borrowers, institutions gain pricing power. If students can borrow more, universities can charge more. And they did. Over the past several decades, tuition has increased far faster than inflation in many countries. Particularly in the US, administrative staffing expanded. Campus facilities became more elaborate. Universities competed not just on academics, but on amenities, residency halls, recreation centers, branding. Higher education began to resemble a competitive marketplace. But the deeper change wasn't just rising tuition, it was the narrative shift. College stopped being framed primarily as a civic good and started being marketed as a private investment. Politicians and economists emphasized lifetime earning premiums. Charts circulated showing how much more college graduates earn compared to non-graduates. The message was clear: borrow now, earn more later. This framing aligned perfectly with broader economic trends. As manufacturing declined and knowledge sector jobs expanded, degrees became gatekeepers. Employers increasingly required credentials for positions that previously relied on training or experience. A bachelor's degree became the new baseline.
Back here in the United States, the Trump administration is weighing a dramatic shift in how federal student loans are handled, in a move that could impact about 45 million American, sources including Reuters.
In that environment, opting out of higher education carried risk, but opting in required debt. And debt, by design, is binding. Today, millions of borrowers carry substantial student loan balances. For some, repayment lasts up to 10 years. For others, 20 or even 30. Interest accumulates, missed payments compound. The psychological weight of long-term obligation shapes financial decisions long after graduation. But student loans aren't like other forms of consumer debt. In the United States, they are extraordinarily difficult to discharge in bankruptcy. Collection powers are unusually strong. Wages can be garnished, taxed refunds seized. In some cases, even Social Security benefits can be offset. And this isn't typical market risk. This is structurally enforced repayment. Why structure it this way though? Well, because over time, student loans become more than just assistance programs. They become financial assets. Loans can be bundled, securitized, sold to investors. Future repayments become predictable revenue streams. The reliability of repayment increases the value of those assets. In other words, education isn't just financed through debt. It feeds financial markets. And this process is part of a broader phenomenon often called financialization, the transformation of everyday necessities into revenue-generating instruments.
China's
Housing
weather
becomes
agency has
mortgage-backed
issued its
securities.
highest level
Healthcare
rainstorm
becomes
warning
insurance
yet
products.
for the south
Education
of the country.
becomes loan portfolios. The students become both customer and collateral. Meanwhile, the promise attached to that debt grows more complicated. It's true that, on average, college graduates tend to earn more over their lifetimes than non-graduates. But averages conceal variability. Outcomes differ dramatically by field of study, institution, geography, and broader economic conditions. A degree in engineering produces a different income trajectory than a degree in fine arts. A recession can derail early career opportunities. Regional job markets fluctuate, but the debt remains constant. If the investment pays off, the borrower benefits. If it doesn't, the borrower still owes. That asymmetry defines the trap. Universities receive tuition regardless of post-graduation outcomes. Lenders collect interest, investors receive returns. The individual bears the uncertainty of the labor market. And because higher education is increasingly treated as mandatory for stable employment, participation feels less like a choice and more like an obligation. There's also an inequality dimension. Students from wealthier families often graduate with little or no debt. They can take unpaid internships, pursue lower-paying public service roles, or take entrepreneurial risks. Students from lower-income backgrounds often graduate with significant balances, limiting flexibility. Debt shapes life decisions. Research shows that high student loan burdens are associated with delayed homeownership, delayed family formation, and reduced small business formation. Monthly payments compete with savings. Risk tolerance declines. Even career paths shift. Graduates may prioritize higher-paying private sector jobs over socially beneficial but lower-paying fields like teaching or nonprofit work, not because of preference, but because of repayment pressure. The ripple effects extend far beyond individual borrowers. When an entire generation carries substantial debt, macroeconomic consequences follow. Consumer spending patterns shift. Household formation slows. Wealth accumulation becomes more uneven. And as tuition continues to rise, the next generation faces very similar choices. Some argue that rising costs are inevitable, that modern universities are expensive to operate, that research infrastructure is costly, that global competition requires investment. And yes, there is some truth there, but cost growth alone doesn't explain the financing structure. Other countries have made different policy choices. Some heavily subsidize tuition through taxation, others cap fees. Some offer income-based repayment systems integrated directly into tax structures. The balance between public funding and private borrowing varies widely. The student debt model reflects political decisions about who should pay. Should higher education be funded collectively, reflecting its broad social benefits, or individually, reflecting private returns? When funding shifts toward individuals, debt fills the gap. And once debt becomes central to access, the system becomes self-reinforcing. Universities depend on tuition revenue, lenders depend on repayment streams. Policymakers become cautious about disrupting financial markets tied to loan portfolios. Reform becomes complicated. Debt forgiveness debates illustrate this tension. Advocates argue that relief would stimulate economic activity and correct structural inequalities. Critics argue about fairness and fiscal cost. But underlying both positions is recognition that the system has grown enormous and deeply embedded. What began as assistance has evolved into architecture. Looking ahead, technological and labor market changes may intensify the issue. If automation reshapes industries and new skills are required, more education, not less, may be necessary. But if access to that education depends on borrowing, inequality could widen even further. The central question, though, remains: is education a public infrastructure investment, like roads and utilities, or is it a private commodity purchased for personal gain? The answer determines who bears the risk. And right now, in systems dominated by student lending, individuals shoulder it. They sign promissory notes at 18 years old, they project decades of earnings into an uncertain future, they hope the labor market cooperates. Sometimes it does, sometimes it doesn't. But the payment schedule persists either way. Education has immense value. It expands knowledge, increases productivity, fosters innovation, and strengthens democratic institutions. The debate is not about whether education matters. It's about whether access to it should require long-term indebtedness. When opportunity depends on leverage, mobility becomes conditional. When learning is financed like a mortgage, the classroom becomes collateral. And when millions carry balances that shape their decisions for decades, education ceases to be just an academic experience. It becomes a financial commitment that outlives the degree itself.